Hi everyone, it's Alex here at Cestrian Capital Research. Welcome to a very special webinar on the topic of hedging. I'm not going to say very much on this because the webinar is going to be run by Kellen, who runs his business Trading Gains. He's a long-time finance professional, a long-time investor and trader who has a particular skill in hedging and hedge trading, and he's going to come and talk to us all about that method and give you some worked examples. He wrote a terrific article for us on Seeking Alpha recently, which many of you have seen. If not, if you go to our profile there, it's the most recent article in our profile, which you can click on and read. Before we do anything, I'm going to read out our standard disclaimer, which is on your screen right now. Like all our webinars, we're going to run this on a live and open mic basis. So once the disclaimer is done, I'll switch all microphones on, and I'm going to switch the presenter window over to Kellen, who'll take it from there. If you have any points, comments, questions, anything at all through the course of the webinar, then best way to get that across is either open your mic and shout into the system, or alternatively, you can use the question or the comment function on the webinar, and we'll keep an eye on that. Okay, so let's do our disclaimer. So this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrian Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrian Capital Research. Cestrian Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so two things to do. Let's first of all switch microphones on. Okay, mics are now on. And then secondly, I'm going to switch presenter over to Callum. Take it away, Callum.
Hey everybody, how's it going today? Glad to be a part of it, and thanks Alex for the warm welcome. Yeah, my name's Gaines. Some people call me Kellen. I guess that's my normal name, but I typically go by Gaines on the internet because, as you know, the internet's forever, so you probably don't want to be sharing all of your personal information. But anyways, so basically what we're going to talk about today is hedging, and I want this to be sort of like a discussion, right? Or I mean, I have some questions. I mean, obviously I want to get through some of the material, but just to kind of set us up here, and now that the market's kind of grinding away right now, I tried to pull up the Nasdaq here just because we had Meta earnings, and I thought it'd be a really good opportunity to talk about hedging and how to navigate these troubled waters, if you will, when we do have these sort of extreme volatility events. So basically, I run my own service here. Try to practice hedging. We publish all the trades. Pretty much it's just something that we would like to practice, especially if you're trading like ETFs as a pair, trading option spreads, things like that. There's different methods that we'll go through here in a second. But so I guess before we get rolling, I wanted to make sure that we all at least got grounded on what hedging was. There's a big difference between people that just go long in a stock and don't have any protection whatsoever. And the difference is something like, let's say, Wall Street bets, where all in on a single stock, that kind of thing, pretty risky, but you might get lucky. It's kind of like buying a zero day till expiration option, where it's sort of like a lottery ticket. You might get lucky, or you might lose all of your money probably instantly if you make the wrong call, right? Well, the market's been in sort of like easy mode, I guess you can say, for the last year and a half, where we've only had a couple of bumps in the road over the last I guess the same sort of time frame, where there's only been like a 2 or 3 month window, like back in last year, July through October, where we had a decent sell off, and then we also had a couple of short little sells here and there. So what I wanted to do here is just talk about what happens when you're sort of expecting the market to turn around here, or and again, this is my own opinion with this. This is not anything Cestrian related. This is more of like, let's just talk it through as an example. Um, so hedging in general is really just protecting yourself against anything unknown, especially just in the market. So it's a little bit more difficult to do if you have a lot of single stocks, especially if you have, let's say, 40 or 50 single stocks in your portfolio. It can be a little difficult to manage. But let's say you're mostly like an index trader, where you buy the S&P or you buy the Nasdaq and you just hold it. Or let's say you have let's say you're long TQQQ with the Nasdaq, where you have those leverage returns, which can be sweet. However, they can be they can also they can also take out an account pretty quickly if you don't really know what happens, or like at least how to protect yourself from the downside. So it is the most important thing you can do for your account. It's not it's not how many buddies you talk to who say the stock is going up, whatever. It doesn't matter. It's still your money, and you need to be able to protect it, and know how to protect it. So the education behind this is really the different styles of hedging that you can use, and it all depends on your portfolio. I mean, obviously, I don't know any of your portfolio and how that's going to work, that kind of thing. But we can just go through a couple of a couple of options, I guess pun intended, for a couple different scenarios here and just talk it through. So the first one is really like so partitioning an account. You want to make sure that you have a certain amount of capital stacked away into chunks for investing in certain stocks. So some people say words like overweight or underweight. It really just means the same thing. It's just taking let's say a $250,000 account and chunking it out into, let's say, $10,000 increments. So you get about 25, call them units. All right, and really what you want to do with that is you want to, according to your risk tolerance, of course, is set a certain amount, like let's say 3 units is a maximum for a single stock trade, or let's say a single index play. The example I used in the article was, if you put, let's say, like a 3 unit trade, so 30,000, using the same example, and let's say in the S&P, and then another 30,000 into the Nasdaq, you already have a very broad, diversified sort of portfolio already. And that's just because there are so many different stocks that comprise the indexes that it just has a very, very wide coverage. So with the S&P, you have a lot of different sectors to cover, a lot of different things. So that's really the first thing, the first type of strategy, and that's by far the easiest because it's really just one sentence, and everybody knows diversification is a great way to cover your backside here when the market starts to slide. So you're not whipsawed back and forth. So that's really the easiest way. The second way is, I would say, probably the most widely used with at least a lot of the people that I've discussed hedging with, a lot of just a lot of people in general who, and again, this is not representative of the whole community, of course, but from what I understand, using things like, let's say, leveraged ETFs or just ETFs in general to protect against any sort of downside risk is, you don't have the risk of time like you do with options or futures somewhat, but options, you get that decay every day, which is kind of a pain. So you can watch your account evaporate while you're waiting for something to happen. And there's a reason why I've been kind of frozen on this one screen here as I'm sharing, because as soon as we start to talk about this method here, you're going to start to see some of the value for that. And I'm going to be drawing on the screen here, so please interject if something is not clear or I'm talking way too fast, which always happens, and or my jokes just suck. So you can tell me that too. I'm working on the jokes. Well, we'll see if we can get any better. That'd be a great spot for a laugh track next time there, Alex. So the number two strategy that a lot of people use here, including myself, is using ETFs, or using inverse ETFs with leverage. So let's say you have, I guess we'll use like a leverage example because that's more fun. I mean, who doesn't like who doesn't like leverage funds, I guess, unless you got burned by them in the past. But don't be afraid. We have lots of different things we can talk through here. So let's use what's going on in the market today. Let me get this out of here. So pretty much what you're looking at is you're looking at the NASDAQ. And let me get some of these lines out of here. Now I know that there's some wave patterns and things like that on the chart here. You don't have to be an expert or any of that. Just understand that there are different methodologies for trying to determine where you're at in a market cycle. Overall, before we dive into the whole thing here, before we dive in, I know it looks a little bit cluttered here, but there's a purpose behind this. In Elliott wave theory, there's typically five waves in an ending pattern. Now, I personally believe this is an ending pattern. Again, not representative of Cestrian and anybody else who may be be fully long. I guess it's just really just an example, guys. And also too, the market needs two to tango, right? So you need bulls and bears, right? So from the chart pattern perspective, I guess my classical training has been more technical analysis. And, I guess I think about it like the charts, it's kind of like, thinking about the setup, right? So if you're thinking that the market is going to take a downturn, or you're thinking that, it's just gone too far, too fast. So whatever the reasoning is, you can use different methods. Like you can use your, technical analysis skills. You can use oscillators. Down here I have like an RSI. You can use all sorts of different indicators. And the best part is none of them are wrong. There's many different successful trading strategies out there, or strategies to determine whether we're at tops or bottoms. Just pick one. But the only thing you need to know is just master it. It's not advice really. It's more of like, if you want to be successful trading or successful with managing your account, you have to know basic things. You have to know what support is, what resistance is. You need to know at least some sort of terminology that will make you a much better trader or investor, just by being able to speak the language. And it is a new language. It takes you a couple years to learn like how all the data works, how the macroeconomic factors stimulate the economy or don't, like for example rates. So knowing all that stuff can help you determine whether we're close to a top or forming a top, that kind of thing. So I guess I don't want to beat that drum to death here, but what I'm trying to say here is that this sort of pattern, it can mean an ending pattern. And with that being said, let's say that you think the market's gonna sell off 10% tomorrow, something like that. Lots of people like to make those determinations and like to have hard and fast dates, but you really just got to have patience. It's not necessarily a wrong call. It's just your timing was off, right? So sometimes, I guess I shouldn't say sometimes. Most of the time, bears are too early. Guilty as charged. Most of the time, bulls stay too late to the party, and it's that psychological aspect of not being able to really change your opinion on where the market is, because you're either so heavily invested, or you've over allocated capital and you're a little bit underwater somewhere, somehow, some way. There's all these little tricks that happen with price action throughout the day to kind of intended to separate you from your money. And it's just learning to read those tea leaves is really a good way to do that. So that's sort of the setup. It's in summary, it's just kind of determining where we're at in the market, and if you think it's going to go up or you think it's going to go down, and depending on your positioning. So these steps here are really just three basic steps. It's just adding downside protection, close it when you think we're gonna stop selling, and then open it back up, or open up some inverse position if it exceeds the target that you had for selling. So in order to do that, like in real time here, we're just going to take this NASDAQ chart at the 2-hour level. Now, typically, when you see like an ABC pattern and you see these sort of ascending wedge patterns, those are, I guess, they could be typically bearish. You've been surprised before, of course, but they can be typically bearish. Now, assuming that you think that, so right here we're pretty close to the end of this sort of pattern. And I want to take out some of this other junk here so it's a little bit more clear. But basically, there's this tiny little range here that we've been trading through the last, really couple weeks here, and I think it's been burning a lot of options, options players. It's been burning a lot of, theta. It's been, a lot of people that added downside protection to September, October, waiting for the seasonality to essentially deliver, for shorts. That just hasn't happened. But typically, during election years, we don't really see a lot of heavy selling in September and October, or typically it's concentrated on in September. But from the downside perspective, what you want to do, or at least like how you want to assess, is this pattern overall is bearish. Okay, so let's say 60% chance we have a bit of a pullback. Well, now we need to figure out where it's going to go. So typically, at least some traders, again, there's many different systems. It's just, one system that works really well for my trading style. And please, stop me if this sounds like, wizardry and, and crystal balls and stuff. But, doing this for many years, there's certain things that you've noticed over time, like with price action. So typically, if you have a pullback, you can retrace, let's say, something like 50% of a range. So this red line here, this is how I'm going to illustrate, I guess, like where you would want to try to, time hedges and things like that. So, and again, please stop me if I'm going too fast or if this doesn't make sense. But definitely not if my jokes are terrible. You need terrible jokes, terrible dad jokes. All right, so let's assume here that you think. What was that? Sorry, is somebody going to say something?
Yeah. Hey, sorry, I have a question. I'm not, I want to challenge you on why this is bearish, because I see higher highs and higher lows.
Okay. Oh, okay. So why it's bearish? So this pattern itself, this megaphone sort of pattern, you have these, you do have these, higher lows and then the higher highs. But that's, I mean, if you remember back in August, that August 10th, we had this big Japanese yen carry trade sell off, and that was huge. That was about 5-6%. And the only thing we're missing though is that third connection point to an upper or lower trend line. Typically, ascending wedges are a bearish structure, but in the larger structure here, which is the megaphone pattern, it can be it can be bullish. Yes, it just depends on where you have a breakout. So I don't know if I answered your question correctly, but I guess why I think it's bearish is really just because typically you'll see, like, if this was just a normal ascending wedge, you would see some sort of here. Hopefully this helps. You would see some sort of ABC pattern that would develop, and it depends on what the first leg is, like how the wave structure develops, so on and so forth. But in a larger pattern, it can be bullish, but as you can see here, we're starting to see a little bit more. Sorry, like let me pull up the daily here, because it's a really good question. So if you see the volume pattern here, we see that the volume has increased significantly since that August 10th Japanese yen carry trade blow up. And we've also seen some buying, sure, and some selling, but when you watch the price action every day, you can kind of get a feel. Like different indexes kind of have a feel to them when you're trading them. Like Nasdaq moves a little faster, the S&P is a little sluggish, the Dow is everybody goes to dinner at 4 o'clock kind of thing. It's kind of sluggish, and then small caps are more like an erratic sort of index. So
guys, it's Alex here. Sorry to interrupt. I think it'd be great if we can focus on the hedging method. And why I say that is because none of us here know whether the market's going to go up or down tomorrow. No clue. And all of us, no doubt, have different views on it. And as Gain says, we can all interpret the chart differently. I think it'd be brilliant if we can use this as just a worked example of, let's say that, let's just take this as this is a business school exercise. Let's assume that market drops like a stone tomorrow. what other methods one can use to protect against that. Whether it does or does not, none of us know. But the skill here that Gaines is bringing, and the thing I really want us to focus on is the hedging method. So could we focus on that?
Okay. So using this current example here. So let's say market drops like a stone, like Alex just said. What kind of markets always move in waves, right? So you can't necessarily you're never going to be able to time all of them, but usually you see some consolidation at lows or at highs. Typically more at highs, really. But when you see a pullback like this, let's say this 8%, being 50% of the range, and it's also getting close to, let's say this turquoise line is the 200 daily moving average, and this purple one is the 50 daily moving average. So when you do have some sort of pullback like this, typically 50% is the first spot that you would look for a bounce. So I always like to call it the bifurcation point or the bifurcation level, just because when you get to a level like this, you could either see a further continuation down, or you could see a bounce back up. And this dotted line here, this is also called the point of control. So what that means is for the entire range that you see in the screen here, all of that volume, mixed together, all of that, price and all that sort of, all that sort of goodness there gets distilled down to this is that one line that has the, not all, on average, the most volume that's been traded hands. So typically what you want to look for with the hedging scenario is you'd want to see that as like a bouncing point, whether it's either up or down. But also the first leg down is typically the hardest to forecast. So that's why it's important to understand like what to do and when to do it. So with that first example here, what you typically would do is like right up here, maybe take out some downside protection. So the short side against TQQQ for NASDAQ is SQQQ. And not an endorsement to go out and buy it or anything, but the reality though is that if you're trading hedged ETFs, you'll want to match that with another hedged ETF with the same sort of leverage, because then if you have to hold it a while, everybody has heard horror stories of holding leveraged funds for longer than they should. It says right in the prospectus, this is not to be a long-term trade, that kind of thing. However, the way that the math works behind it, it just compounds daily. So if you have a big sell day and then you have a big buy day after that, it's not going to be a one-to-one match if you buy and hold, that kind of thing. But if you buy the inverse fund, then in theory it should capture everything that the tops or that the long side loses, with a little bit of drift. But overall, if you had that S or that position of SQQQ, let's say you hedge the entire thing, your entire portfolio 1-to-1. Let's say you have all NASDAQ shares in there, and some people might. So I think we measured this out as 8%. So if it does drop by 8%, so once we get to this line here, so you consider, okay, well, it's a bounce. So what you would do is once you start to see some support develop, and again, like have patience with it. It could take a day, 2, 3, but prices don't typically stay at the lows for long, especially in this bull market. It's like, the market dips 0.5% and everybody swoops in with a bag full of $1 million and, buys it back up to the moon again. But eventually that's not going to work. Eventually, these guys, the big institutions are going to run out of inventory. And that's where you see some of these larger sort of, patterns developing here where you start to see a lot of volume. And that's, indicative of distribution. Can also be accumulation on some sides, but mostly since the market is pretty high, you see a lot of this sort of distribution. So if the market is going to be, pushed down here, you could set something like a stop. So for example, let's zoom in a little bit. Again, using the same example. So let's say over the last low that we had yesterday before the Google earnings, so something like, I don't know, let's say 2280. So you could set a stop to like a buy stop to buy SQQQ. And that could, let's say once that triggers, if it breaks this lower, I'm sorry, let me zoom in a little more. This might be a little difficult to see. The level I'm talking about here is this last low that was yesterday. Now this is a very, very short time frame. Okay, this is not for everybody. You could just as easily pick pick a level that has stronger support, like let's say down here, where the last on the October the 23rd here, we had that last low. But some people like to to move up the stops as they see fit, and also with this range here, as we talked about before, this point of control, you could have this stop right below that. So it's all really just on your own risk tolerance. So if you want to try to keep it tight, keep following up the trend and keep keep setting it a little bit lower than the last local low. You could do that, but you could get also you could get your stop triggered though if you do have some sort of selling, like let's say right here, where where it did kind of dip pretty quickly, but then got bought up, and then you'd be stuck holding a lot of hedges here, have a lot of capital tied up, and as of the 23rd here, so it's really only been a week, so it's not too bad. But if you were wrong, let's say 2 or 3 months ago, well, that's a different story. You just have to hold them, and either you take a loss or you hedge. And part of the beauty of hedging, though, is being able to compound those returns. So using the same example, let's say market market dips below here, and then we see something like this, kind of like a ABC sort of drawing. Well, if you've held on to let's say it gets down here, this 19,745 level, and once you see it kind of develop some support, so something similar to how you would see this develop, where I mean it kind of was grinding around for a couple days here, where this might give you some some idea that okay, well see some supports building, so close out your SQQQ shares, and you can still treat this as that moving bifurcation zone too. So if the market does sell down some more, and always look for the volume too. If it does sell down some more, you can always set that stop order again below that local low. And that's just something that I think is just good practice in general, where now that markets have been sort of complacent for a while, sometimes sneaky moves happen, right? And you could be caught wide open long without any protection level set, and then go to bed for the night, and then wake up tomorrow morning and market's down 2%. Well, recently we just heard that the Dow Jones is going to have electronic trading hours extended. So you could essentially use ETFs and set those sort of orders and get a much better fill, as opposed to having to wait until the cash session opens in the morning, or if it gets triggered, that kind of thing. Sometimes you can have a bad fill with a stop, especially if the price moves a lot. So I guess suffice to say here, you still want to just be aware that anytime you see these like consolidation zones and you think that the market's going to stop moving, well, that's where you'd want to close those short hedges. And I guess it's not advice, but it's more of experience, just saying you don't want to hold on to short hedges very long in an uptrend.
It's actually Gaines, I'm going to butt in. So I want to really emphasize what Gaines just said, which is it's possible to trade without any opinion as to whether the market's going to go up or down. But let's say you have a thesis, and let's say your thesis is the bull market that we're in is going to continue. And let's say your thesis is, if there's a pullback, I want to at least protect my capital or maybe try to benefit from the pullback. If you're in a bull market, shorts that overstay their welcome can really hurt you. And your analysis has to be good enough to go, okay, I bought a hedge, whatever it is, an inverse ETF, a put, whatever it might be. My hedge is in the money. Okay, I'm going to be bold enough and brave enough to take the profit, because I can know that, well, if I sold the short too soon, in other words, let's say I bought SQQQ or PXQ or something, and let's say the NASDAQ drops, and let's say I'm in the money, it's green, great. You could be bold, you can choose to sell that, and you've basically caught some free money. The market selling off has given you some free money. The mistake people make, in my experience, a big mistake, is to go, I'm getting scared, the market's gone up a lot, I'm going to hedge. I'm going to hedge everything out, and I'm going to be completely neutral. And so if the market falls, that's great. I'm not getting hurt. But then what happens is they hold on to the short for too long because fear sort of grips them. A short in a bull market is a dangerous thing if it's used incorrectly. It's a wonderful thing if used correctly to profit from pullbacks because it gives you free money that you didn't have before that you can use to reinvest in the long. So the point I want to really bring to the fore that Gaines just made is don't overstay your welcome with short hedges in a bull market. Use them wisely. It's free money. Get complacent with them, as he just said, and they'll just eat all your profit.
I like that. That's good. It's free money. And we like free money.
It's free money. The market, if you learn to speak market, if you learn the rules of the market is a free money machine. Right? It gives you free money most days, most weeks, most months, most years, if you learn its rules. Right? If you try and fight the market, it just takes your money. Simple.
Yeah. It's a great way to put it, Alex. Thank you. So, with that being said, a lot of people get into trouble when they hold shorts too long, like Alex just said. And yes, I can completely confirm that. It's happened to me a couple times. But hey, can't win them all, right? But Alex is also right where nobody knows where the market's going to go the next day. There could be a huge sort of black swan event sort of thing, and catch everybody by surprise. And there's also events too that happens where catches a lot of analysts by surprise too. So the main question is really like, how do you determine where to add the hedges? So let's just say, for example, this ascending wedge pattern here, it's got these connection points, like we talked about before. And typically, if you do see a breach of a trend line like this, you more often than not, I'd say probably like 75% of the time, you'll see a back test of this trend line. And in this sort of example, that would be like a B wave. If you follow, Elliott wave theory, and those could take the shape of like a triangle, something like that. And I think there's actually a really good example here with small caps. Let me just pull that up quick. So small caps, yes, great example. So small caps here, you can kind of see they breached the trend line to the downside, and they've just been kind of grinding up here, back testing this trend line. But as you can see, it's been having a really tough time trying to reclaim that trend line. And that's typically, I guess a characteristic of a B wave. And also this doubles as a bearish sort of channel. So I guess long story short is this is a great example where like if I was trading this with my own money and I was in small caps, this is where I would add a hedge. And even if it's still right here, where I would add is on breach of this sort of trend line, because that is, I guess that's the way to play a bear flag, or the inverse if it's a bull flag. It works both ways. So to go back to the Nasdaq example here, if you do see something like that happen, you could absolutely re-add those shorts right here. And just as another example, like over the last on the flip side with the bull trade, I've been able to at least with our fund here, at the Gains Fund, we've been able to sell out our longs like here, and then rebuy them back here, sell out here, rebuy them here, and we just did the same thing today. So we've essentially made the same hedge trade 3 times in a row, and we pocketed some pretty nice wins from that. And that's just waiting for something else. So you can make money both ways. And as Alex said, and I love it, I'm going to steal it if he doesn't mind, but it's free money. But the trick is you just need to know where to add them and where to take them off. And always keep your eye on the trend too. So if the trend is up, even if it looks like the pattern's going to roll over, still just be quick to take those short profits and don't stay too long. You don't want to be that dinner guest that stays too long, right? So I guess the long story short here is you always want to try to figure out the best points, and that can come from technical analysis. It can come from your oscillators, RSI, whatever your trading strategy is, and that's an important point to mention. Is just because you don't have to be a technical analyst. Sorry, what was that, Alex? Go ahead.
Yeah, no, I was just going to say that there's many technical methods you can use to time a short. What you can't use, in my opinion, is the news or fundamentals. So the news is of no use when it comes to hedging, because by the time the news, which isn't, it's not news to anyone that matters, it's only news to the rest of us. By the time the news hits, then the moment's passed. And fundamentals of companies or GDP or inflation or anything like that, any real world numbers, they're of no use. If you want to learn to hedge, you have to learn to be able to fly stock charts. You don't have to use stock charts to the 14th degree of complexity, but in my opinion, trying to make any buy or sell decisions, but particularly hedging decisions based on news flow or company earnings, waste of time. You have to use the charts.
Yeah, absolutely. Yeah, so just understanding like how price moves on a chart, and also one more plus one for technical analysis is you don't have to worry about dark pool funds or blah 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 blah. There's always some sort of weird trading thing that people will swear by, right? You see the ads all over the internet. People swear by this one trick, or the 3 stocks you can buy and hold for forever. Okay, well that's not realistic, but the I guess the real aspect of this is all the volume that you see on the chart, these spikes on the bottom, and then the volume profile on the left, kind of helps you triangulate like what sort of activity is going on at that specific point in time and how much activity is going on. So it really just shows you all the executed volume, and it's like you're reading a book that's already been written and hasn't even needed to go to the publisher yet. So once you figure out how to learn volume, or learn how to read volume, and also a couple basic trend lines and things like that, I do think it'll make you a better trader or investor overall, because everybody wants to buy low, sell high. But I also want to, I guess, buy low, sell high within the same range while it's consolidating, because markets typically consolidate for 70% of the time. So you're just kind of wasting time where you could be making money, twiddling your thumbs, but again, like I was saying, it's dangerous to short in an uptrend, and if you don't know where to release those hedges, then there's problems associated with that. So one other thing you can do here is, let's say you got trapped down here. Down here, let me circle it. So let's say this is your first shorting your first shorting adventure, and it went horribly wrong. So let's say you're trying to target here, but you waited too long, or you slept in, or your alert didn't go off on your phone, you're in a meeting. Not that we all trade in meetings or anything like that if you're working full time. Laugh track, cue it. But I laugh at my own jokes. I don't know. So let's say you held on to the short for too long, and now it's gone up and up. So you might be tempted to take the loss. However, if you added the short at the right place, which was I think we talked about setting that stop around here, you're probably only underwater just a little bit right here. What you could do is, if you're watching your short profits kind of disappear because there's a retrace, you could definitely set a break even stop order for that short position, and you don't make any money, but you didn't really lose any money. So you're kind of like just putting your portfolio into neutral while waiting for this to happen. So I guess the lesson though is take your short profits while the market's going down, but still be aware of like what the price action and stuff is doing. And then a good practice is also before you get up from your chair, like let's say you just make a brand new long trade, set a stop. Set some sort of protection just so you have some sort of semblance of security there. And if you can't sleep at night, your position size is usually too large. Futures or options, or unhedged. That'll definitely have you lose some sleep, especially if the trade goes against you, or if you don't give yourself enough time. With some of those different strategies with like options and stuff. Okay, so just to kind of wrap this up here, like the second trade would really be, if you held on to it, and let's say you set a stop at break even, trying to figure out where to short again. Well, you do this trend line back test. That's where you would want to try to reshort, but then put a stop above, let's say the last high. So you wouldn't lose too many points in either direction, but you're still prepared for either direction. Another thing you could do is you could take, let's say you let's say that you retrace a little bit higher than the trend line, thinking, oh, it's going to be, it's going to flip bullish again, and that we're just seeing some normal like pattern expansion. At least that's what I call it, is pattern expansion. I don't really know there's a technical term for it. Should probably learn that, but for now it's pattern expansion, which can happen. Like we just saw that with oil, where oil had a nice nice triangle, and then all of a sudden it just expanded a little bit lower to the downside, and that changed the changes the analysis a little bit. But let's say you get your the price up here, you could just as easily do like a 50% hedge instead of a full 1-to-1 hedge. There's different ways to do it, so it all depends on your your risk tolerance. What I typically do out in the trading wild is if I like, so right now, if I think this this ascending wedge here, I think this pattern's just getting a little bit long in the tooth. Sure, we could definitely see some sort of pattern expansion to the downside, and then see one more leg up to hit, let's say 2100 or 21,000 here for the S&P or Nasdaq. So you could see that. Yeah, I mean, it's happened. So you have to prepare for that possibility. But if you were able to take that short trade, you were able to play that fourth wave down. Sorry, I don't want to get too technical here, but you were able to play that wave down. So you not only made money with your longs all the way up, but you made money shorting it as well. Now, a smart trader would take that money and reinvest it into the longs and improve your cost basis, or you can just take it and put it in the bank. You could do, you could do a number of things, right? But the key to understand though is it depends on where we are with the different styles and patterns and things. And if you spend a couple hours, pick up a good technical analysis book, that's something that you can get a lot of benefit from. So if you were to set, let's say, so right now I am net short, and the reason is because I think this pattern is it's just gone on for far too long. It's a big consolidation pattern. I think there's distribution going on, but again, that's my opinion. So with that being said, even if we just see this small little pullback here, I would want to hedge long on a breach of the high. So like, let's say, just pick an arbitrary number, right? So something close to the high, but it could be a little bit lower. So that's how I would hedge, with just being short today, where I do have some stop orders on SPXL and TQQQ, but I only have a 50% hedge with that today. So right now, with that 50% hedge, let's say it retraces half of this, but then it breaches the high, I would add another 50%. So that would be, I guess, 1-to-1. But you don't have to do that. You can certainly do just 50%. If you're concerned that you're, essentially buying the top, which nobody wants to do. Okay, so let's continue with this sort of example here. So let's say that we've, you re-hedged up here, you re-hedged short, and typically, if this was, in this example here, if this was a B wave top, the C legs can be very powerful. It's just like a wave 3 in an impulsive trend up. So they can be very powerful. And let's say that the selling is pretty clear. Let's say it takes a week, and typically, at least from my observations, if you're going to have a big sell event, typically it lasts the whole week. Or if you're going to have consolidation, where you see a lot of these, a lot of these back and forth kind of things, usually each day has like a theme. Usually it's a trend day, all selling, and then the next day is consolidation. Then the next day is bulls buy it up, and there's a lot of that give and take. But that's why a lot of, at least my opinion, I think that some of the professionals, they all like to wait till the end of the day to place trades, because that's when all of like the shenanigans and price action and stuff has kind of been worked through the system. And personally, I like to make a lot of my trades at the end of the day as well, just because there's a lot. And definitely not in the beginning of the morning, with the morning drive, because I've definitely seen, morning drives completely reverse, over time. And I just feel like there's a higher probability of success when you make trades after you've been patient and after you've waited for the market to develop a little bit. So, so now that you've hedged the second time here in this example, let's say it heads down to this important level, this 50% retrace. Now, I called that the bifurcation zone before, and that still holds true. But I guess to kind of recap, you've now shorted the market twice, and you've made money twice, and and your long positions, yes, they've deteriorated in value, or some of your profits have evaporated. But I guess really what you're trying to what you're trying to do here is you take that extra money that you got and either reinvest it to improve your cost basis, or again put it in the bank. You have many different options. So now, again, like the most difficult part is trying to figure out when to close. Well, okay, now that we've hit this major Fibonacci level, that's a typical bounce point if we're seeing ABCs everywhere. It could also extend down to like let's say point 618. But suffice to say here, just for the simplicity of the argument, is you could see a larger bounce in either direction. That's why I like to call it the bifurcation zone. And I like to try to treat every every Fibonacci level like that, where it can either go up or down, right? Because it's the market. It gyrates all day, every day. But capturing those big moves is what makes this strategy really sweet. Those what is it? Einstein said the eighth wonder of the world is compounding, right? And he's right. It's you get, let's say you make $10,000 on two nice shorts. You can take that and improve cost basis on a really underwater long trade, and hopefully when the market swings back up, you can get out of that underwater trade. So you don't really have to take a loss. You just have to be patient. So there's different strategies. I talk about a ton of that stuff in my service, and a ton of that, like when I do webinars, and definitely through just having conversations with people about when to take profits, and what's a good idea to do here and there. And it's not advice, it's more of like, it's just strategy about how to play your downturns. Okay, so with that being said, now let's talk about the different types, right? So like you can do this with inverse ETFs, whether it's leveraged or not. If leverage scares you, which is possible, I mean, there are some people that only trade when a stock is above the 200-day moving average or below. And that's a very, very long-term, horizon sort of strategy. But, again, there's other people that do trading through RSI, MACD, different indicators. I'm more of a volume and wave count kind of guy, and so, Fibonacci levels. But, so I guess suffice to say, ETFs are really nice because you don't have to, like, yes, it takes a lot more upfront capital to get the same returns, but you can at least sleep soundly knowing that if you are long using a leverage fund and you have its inverse that you've bought and you're going to hedge 1-to-1, you're essentially canceling any sort of downturn, because you're freezing your portfolio in a sense. You're freezing any losses, you're freezing any gains until you cash out on one side of the position, or one side of the hedge pair, like to call it. So when I guess like a more advanced strategy would be something like options. So there are different things, and I don't want to go too deep into it because there's millions of books on option strategies, and like different, like what the Greeks mean. If I'm welcome back, maybe we can talk about the Greeks another time, because there's a lot of questions on that. But for the most part, when you're using options, you have time. So when you're buying options, time is your worst enemy. But when you're selling options, it is your best friend, right? So in order to sort of cancel out the time risk, if you're going to use options, is to buy let's say there's different types of spreads, right? You can do like a call vertical, or a vertical call spread, vertical put spread, whatever. There's a lot of stuff on the internet for that. There's one book that I really like. I typically have it on my desk all day, is the Options Playbook. Not an endorsement, but it's certainly, I don't know the guy, but I think he wrote a pretty damn good book. But it kind of explains it really easily, where you can buy a put, let's say at let's use the S&P 500. The numbers are a little bit easier, or easier around here. So let's say at 5,800, you can buy a put, and then you could sell a put at, let's say 58.79. So that gives you a 10-point spread or a 10-point delta, and that would be called a debit spread. So a debit spread means you pay the higher premium for the option that you bought higher up because it's a put. So you would make money if the market goes down, but if the market goes down or if it doesn't go down lower than 57.90, then you would capture all that profit. The only issue though is that if it goes below 57.90, you don't really get any of that profit because it capture returns. And but I guess the important thing though is with put options, they can be dangerous. So you definitely want to add some sort of protection against that. So I mean, in the past, I mean, this is years and years ago, but when I was first learning options, I call it paying market tuition, right? Well, first learning options, I didn't know how to hedge it, so I ended up losing, let's say, 10 grand on a bunch of puts that you bought where you think the market was go down and it didn't. Not even close. So, okay, well, what do? You take your loss and learn your lessons and write it down. What did you do wrong and why? So that's why it's important to understand the strategy that you're using and understand the risks and understand what the benefits are, but then also understand where the market is at. And if you do see, some downside or some more downside in the future, what would you do with it? So the easiest way is to do I don't know if some of you guys are old enough to remember the Ronco rotisserie, but it's to set it and forget it. You use ETFs for that. So set it, forget it, and set some stops and things and go cut the grass, and try not to worry about it. With options, it's a little bit more like clear your calendar. You're probably going to have to stare at the screen for a while in order to time it correctly because of the leverage and also the time decay. So if you're going to use options to hedge your account, definitely do some research on it. Don't go into it blind. Don't listen to people on the internet. Do your own research and practice. You can use a paper account with options, but you're never going to get that true that true investor panic. While you're watching real money get lost, which is why I haven't really touched on futures yet. But I used to trade futures for years, and I decided to close my account. And the reason is not because of losing money, but because it was way too stressful. Something that trades 23 hours a day. I mean, you need sleep, right? So again, if you're not sleeping at night, your position size is too large, or you have or you just have too much concentration of capital in one sort of instrument. So the way futures work is it has a lot more leverage because it controls notional value of stocks or underlying stocks. So the delta is sort of 1-to-1. So moves down 10 points. It depends on what the tick value is. I won't go into the details, but basically it's if you aren't able to hedge futures, futures are really more for like larger portfolios anyways, where let's say one NASDAQ contract can control $250,000 worth of notional value. If your entire long portfolio is worth 250,000, then you'll need one mini contract to hedge short. And in theory, that should be a 1-to-1 hedge, but still understand the dangers of the asset class that you're using and avoid those that you don't understand, like the plague. But I would say in all my experience with hedging, and this is the last point I'll make here and open it up for some questions and other comments, but in my experience, the easiest way to make good returns and to have lower, not stress free, but lower stress is to alternate between ETFs and to try to again understand your technical analysis, understand some charting, and kind of know where to buy, where to sell, and also know how to hedge, because you can compound your returns just by actively managing your portfolio. And if you prefer that you just again set it and forget it, you can do that as well. Just make sure that you set some good levels and check on it on occasion. But I think that the most profitable hedges I've ever made, and some trades that monster profits on some hedges. It's been great. Can't promise anything. You got to know how to kind of do it, but it's really you can really protect your portfolio well, and it's kind of nice to get a nice windfall, and then all of a sudden the market gets bought up the next couple of days, and you're right back where you were a week ago, and then you got yourself another $10,000 in your pocket, that kind of thing. So
It's Alex. I'm going to jump in here. We've got 5 minutes left, and Gaines has covered a ton of material here. So I just wanted to give folks just a minute for any questions, comments, anything at all that we want to raise. I'm conscious that this is a really detailed topic. It's a tricky topic to get started with, and so this can be a lot, this sort of webinar. But learning to hedge, speak personally, is one of the steps along the way, one of the small number of steps along the way for me that really transformed my ability as an investor and as a trader. So there's a number of sort of key steps in a multi-decade journey for me, and this was a big one. So even if this seems a bit overwhelming right now, I really encourage everyone to learn how to do it. As Gaines says, try it with paper money if you like, try it with some small money if you like, and just learn the method and learn a method that works for you. So any questions that folks have right now, we can take. And then if there are things that you think about afterwards, or if you're watching the recording, you can hit Gaines up either in YouTube comments or on Twitter, and we'll share the Twitter handle shortly, and then the comments on the video. So any questions or comments at all, folks? Okay, everyone's been bludgeoned into silence. So
I like to think about it like everybody's just blown away. They're like, "Wow, man, I never knew."
Usually when if I get that when I'm watching a webinar myself, it's like, oh, okay, my head hurts. So I'll think of some questions afterwards. I have a simple question, which is, I'm right in thinking, aren't I, that if you learn to hedge, you can make money whether the market's going up or down, and you shouldn't really care. Let's say you're using a NASDAQ hedging method. You shouldn't really care whether NASDAQ's moving up or down. All you have to do is react, right? If you can predict accurately, well, that's great, obviously, but if you can't, you can just react, and you can just ride it long when it's going up and short when it's going down. And learning to hedge is key to being, independent, truly independent of what the market's doing. I'm right in thinking that, right?
No questions at all? Man, I must have done a great job.
Yeah.
Explaining all this, or terrible job. Everybody's probably already asleep. Really.
Here we go. We've got 2 questions coming in here. All right. So, okay, now that's you with your thing. Okay.
Yes,
all right,
folks. Walking on the beach. Sorry.
Well, look, let's wrap up for now. We're going to post a recording in a couple of hours once it's upscaled to HD. And then, again, any questions, hit them up in the YouTube comments or in Twitter. Thanks, everyone, for joining today. Thanks, everyone who's watching this as a recording. And look forward to speaking to you all very soon. Thanks a lot. Thank you, guys. Great job. Thank you.
Appreciate the time.
All right.
Thank you.